It's good to see you, Chris. Welcome.
Great to see you again.
So how do you read today's inflation number as far as what it means for the Federal Reserve's policy path?
Well, I think the inflation number was basically sort of as predicted. I mean, it's on a path. My personal view is I think rates will be higher for longer. And I think probably the move from 8.1 to, to 4 was took a while. I think the move from 4 to 2 is going to take longer.
On inflation. So you think the Fed's going to have to be in the game longer. What about the consumer? Can it hold up? Do you agree with what you heard from Brian as far as what you're seeing out there?
Yeah, the consumer is holding up well. In our book, the consumer today has 50% more cash in their account than they did pre-pandemic. So the consumer, I think, has, they're durable. I think there's certainly plenty of opportunity for jobs. And people that have jobs continue to get raises. So I think the consumer is pretty healthy. What we're seeing is the consumer is spending more, and spending more particularly around activities like leisure, for example. The spend is up about 8% this year for us, for our consumers in that area.
But so what do you forecast? Are you expecting that will at some point cool down because of all the tightening and that we'll go into recession?
I do think we will go into recession. I don't know. I don't think it'll be a particularly deep recession. But the reason I believe that rates will stay higher for longer is I think it's going to take some time for the consumer to really burn through the excess cash that they have. And I just think it's going to be a long but stable road.
Some of the investors around your sector have been worried about deposit outflows, which were down last quarter. And you said at the conference that you don't think that the Fed balance sheet, which they are trimming actively, gets enough attention with respect to how it impacts your business. Explain that.
Sure. Well, so the Fed's balance sheet today is some number like $8.4 trillion. And they're trimming their balance sheet through quantitative tightening about $95 billion a month. And those dollars will probably flow out of the banking system. So it's two impacts. One, it drains deposits out of the banking system. And two, it has the impact of increasing rates, depending on the math, maybe 25 to 50 basis points. So the shrinking of the Fed's balance sheet is a significant factor, both in terms of the absolute level of deposits and also in terms of the rate impact.
Right. And a headwind, I would think. So you've been building up loan loss reserves like some of the other banks. What does the credit picture look like right now and through the rest of the year?
So the credit picture looks good. The reason we built reserves is, as you look at under CECL, there's really three things that drive a reserve build. And the first is the macro outlook. And there's just no doubt that from the third quarter to the fourth quarter, there was a deterioration in the macro outlook. And that really is what drove us to build our reserves. The other two factors are loan growth, and we are enjoying some loan growth. And then lastly, it's sort of idiosyncratic factors, which we are not seeing in our loan book at this time.
Got it. Chris, appreciate you joining us. It's good to get the color.